Good evening from New York. It's 5:50 p.m. on Thursday, April 16th, 2026. Welcome to the Lynx Data Insight market briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are closed for the day, and what a day it was. Records again, oil surging back toward triple digits, and Netflix delivering a headline-grabbing earnings beat that the after-hours tape has already punished. Let's get into it.
Let's start with a tape. The S&P 500 closed at 7,039.37, up 0.23%. That's the second consecutive all-time record close and the second straight session above 7,000. The Nasdaq finished at 24,097, up 0.34%, notching its 12th consecutive winning session, the longest streak since 2009. The Dow added 0.21% to 48,565. The Russell 2000 gained 0.22% to 2,719. The VIX sits at 17.94, elevated relative to a typical record-setting tape, but well below the panic zone. On the fixed income side, the 10-year yield is at 4.31%, the 2-year at 3.61%, giving us a 70 basis point positive spread on a normally shaped curve. Advanced decline was 280 to 249, positive but not dominant. This is a market regime defined by two competing forces: geopolitical optimism on U.S.-Iran diplomacy pulling equities higher week to date. The S&P is up 3.3% and the Nasdaq 5.2% this week alone, according to CNBC. And simultaneously, a supply-constrained oil market reasserting itself as Brent surged nearly 5% today to close at $99.39 a barrel, and West Texas Intermediate settled at $94.69 per CNBC. Those two forces are on a collision course, and Tuesday, April 21st, is the date that determines which one wins.
That April 21st deadline, the ceasefire expiration, seems like the single most important date on the calendar, but the market is clearly betting it gets resolved. Walk me through why equities can keep setting records with oil this close to triple digits.
It comes down to what CNBC described as the taco trade: Trump always chickens out. Investors have been conditioned by the tariff reversal in April 2025 when the S&P fell 12% and Trump paused within days. Joe Seidel at JP Morgan Private Bank put it well: markets are pricing what the world looks like 6 to 12 months from now, not today. And 6 to 12 months from now, the consensus view is the Strait of Hormuz is open, oil is back toward pre-war levels, and earnings growth resumes. Today's Israel-Lebanon 10-day ceasefire announcement added another brick to that diplomatic progress narrative, because Lebanon had been a precondition for Iran's parliament to re-engage in talks. But here's the contradiction worth surfacing. Brent closed just 61 cents below $100. Several European and Gulf Arab leaders told Bloomberg they believe it could take 6 months to negotiate a full U.S.-Iran deal. So equity investors are pricing a quick resolution while the oil market is pricing a prolonged disruption. One of those views is wrong, and we'll know which one by next Tuesday.
And that oil move didn't just show up in the commodity, it showed up in very specific equity losers today. Before we get to the full winners and losers breakdown, let's connect the cross-asset picture.
This is where the mechanism matters. Start with oil. Brent at $99.39 feeds directly into gasoline prices, which according to data from AAA cited by CNBC have risen 49% year-to-date from roughly $2.75 a gallon to $4.09. That crushes consumer purchasing power and transmits into input costs. PPG Industries announced a global price increase of up to 20% today across its portfolio, explicitly citing petrochemical and energy cost volatility. That input price surge is confirmed by regional Fed data. The Philadelphia Fed Manufacturing Index printed at 26.7, strong on activity, but the prices paid component surged nearly 15 points to 59.3. The New York Fed Services Prices Paid Index jumped 11 points to 73.8, which CNBC described as a sharp acceleration in input price increases. Now connect to bonds. The 10-year at 4.31% and the 2-year at 3.61% are remarkably stable given that inflation data, which tells you the bond market is still giving the Fed the benefit of the doubt that this is an energy-driven and therefore potentially transitory shock. But the bank earnings tell a different story beneath the surface. JP Morgan's fixed income revenue jumped 21%, Morgan Stanley's was up 29%, and Citigroup was up 13%. Goldman was the outlier, with fixed income revenue falling 10%, reportedly caught wrong-footed on rate positioning when the market repriced from expecting 2 cuts to pricing no action. That Goldman stumble is a micro-illustration of the macro risk. If you're positioned for the old consensus and the oil shock lingers, you get punished.
Wait, the fact that Goldman's vaunted FICC desk got caught offsides on rates tells you something about how fast the consensus shifted. What does the current yield structure actually tell you about the Fed path from here?
The 2-year yield at 3.61% is essentially pinned to the Fed funds proxy, also at 3.61%. That's the market saying no rate move in either direction for the foreseeable future. Fed funds futures, according to CME FedWatch data cited by CNBC, show the overnight rate ending the year in the 3.50 to 3.75% range, exactly where it's been since December. Former Cleveland Fed President Loretta Mester endorsed that today, telling CNBC at the Semaphore Conference that the Fed is wise to be on hold now and to wait until we get more information. But she explicitly flagged the upside risk. There's a scenario where inflation continues to move up because of the war, and the Fed has to be prepared for that. Here's the key distinction. The Fed typically looks through energy shocks because they tend not to contaminate core inflation unless they persist for multiple quarters and become embedded in wage expectations. We're 6 weeks into this disruption. If Hormuz reopens in the next 2 to 4 weeks, this stays a headline inflation event and the Fed holds comfortably. But if the blockade extends through summer, you start getting second-round effects. Diesel at $5.65 a gallon, according to AAA, means higher shipping costs, which feed into food prices, which feed into services inflation, which is sticky. That's the transmission mechanism that would force the Fed to contemplate hikes rather than cuts. The 70 basis point yield curve spread suggests the market currently sees a benign resolution, but that spread would compress violently if 10-year yields push toward 4.60 on a sustained Hormuz closure.
So, who are the clear winners and losers from today's session?
On the winning side, cyclically, Albemarle was the standout, up 12.93%, the largest single-day gainer in the S&P 500 movers. That's a lithium and basic materials play benefiting from the broader commodity rally. C.H. Robinson rose 7.56%, a logistics company catching a bid on trade normalization hopes. Then semiconductors dominated. 6 of the top 10 were gainers. Dell Technologies gained 7.51% on AI infrastructure demand. ON Semiconductor was up 7.50%. Intel advanced 5.26% after Bernstein raised its price target to $60 from $36 on server CPU strength. And Advanced Micro Devices hit an all-time high, closing up 5% on a 12-session winning streak after Bernstein lifted its target to $265. Structurally, financial services has the broadest participation of any sector, 87.55% of stocks above their 50-day moving average, 44.80% near their highs, and only 2.31% near lows. That's an $8.61 trillion sector being powered by the steepening yield curve and record bank trading revenues. Real estate is showing strength too, 74.55% above the 50-day, 43% near highs, a rate-sensitive recovery trade that's working despite elevated long-end yields because the market expects eventual easing. On the losing side, today had a very specific casualty, cruise lines. 3 of the top 4 losers were cruise operators. Royal Caribbean dropped 6.32%, Norwegian Cruise Line fell 5.96%, and Carnival lost 5.50%.
According to CNBC, at least 6 cruise ships remain stranded in the Persian Gulf, and Carnival explicitly does not hedge fuel prices. With diesel at $5.65 a gallon, their margin structure is getting squeezed from both sides, stranded assets and unhedged fuel exposure. GE Aerospace fell 4.89% and Axon fell 4.68%, reflecting broader industrial sector weakness under elevated energy costs. Structurally, consumer defensive is the sector in the worst shape, only 40.52% of stocks above their 50-day moving average and 14.04% near 52-week lows, the highest near lows reading of any sector. This is a $3.71 trillion sector being quietly crushed by input cost surge, but pricing power is limited for staples producers. Consumer cyclical breadth is weak too, just 13.85% near highs versus 51% above the 50-day, the weakest breadth.
That consumer defensive reading is striking. The supposedly safe sector has the most stocks near their lows. Let me pivot to Netflix because that earnings print after the bell is going to dominate tomorrow's open.
Netflix reported first-quarter earnings per share of $1.23 versus the 76-cent estimate, a massive beat, nearly double what they earned a year ago. Revenue came in at $12.25 billion, above the $12.17 billion consensus. But the beat was heavily inflated by a $2.8 billion termination fee from the failed Warner Bros. Discovery acquisition. Strip that out, and the underlying business is solid but not extraordinary. Here's what sank the stock 8 to 9% in after hours. Second quarter revenue guidance of $12.57 billion missed the $12.64 billion estimate, and EPS guidance of 78 cents came in below the 84 cents expected. Operating income guidance of $4.11 billion was well below the $4.34 billion the street anticipated. And then Reed Hastings, the co-founder and current chairman, announced he's leaving the board in June. Bloomberg intelligence analyst Geetha Ranganathan captured the sentiment. This was supposed to be the quarter where Netflix proved it's fine without Warner Bros. Discovery, and the guidance doesn't necessarily do that. This matters for the broader market because Netflix is a bellwether for consumer willingness to absorb price increases. They raised prices for the second time in just over a year. The ad-supported tier went to $8.99, premium to $26.99. If the consumer is already strained by $4 gas, Netflix's ability to keep pushing pricing is the canary in the coal mine for subscription and services inflation more broadly.
That connects directly to the consumer stress we were discussing. Now, what's the risk case investors should be stress testing heading into next week?
Our base case, which we'd assign a 60% probability, is that the diplomatic momentum continues, the Israel-Lebanon ceasefire holds, weekend U.S.-Iran talks materialize, and the ceasefire gets extended past April 21st, even without a formal deal. Under that scenario, S&P 500 trades in a range of 6,900 to 7,150, the 10-year stays between 4.20 and 4.45%, and Brent trades between $88 and $100. The Fed stays on hold through at least the third quarter. This is the taco trade playing out in slow motion. Markets grind higher on hope while the economic data degrades gradually, with a couple quarters under 2% GDP growth, as Sage Advisory's Rob Williams warned. The risk case, which we'd assign a 25% probability, is materially more severe. The trigger is the ceasefire expiring April 21st with no renewal and no deal progress. That keeps the Strait of Hormuz choked, pushes Brent sustainably above $100, potentially to $110 or higher, and reignites the stagflation repricing that drove the S&P down roughly 8% in March. Under that scenario, the S&P could revisit 6,500. The 10-year pushes to 4.60% as inflation expectations re-anchor higher, and the Fed is forced to contemplate rate hikes rather than cuts. The causal chain is Hormuz phase blocked, Brent above 100, diesel stays above 550, Shipping and food costs accelerate. Core inflation metrics start moving in the wrong direction by late second quarter. The Fed's reaction functions shifts from patient to hawkish, and the entire taco trade thesis collapses, generating a full correction. The upside tail, at 15% probability, is a formal U.S.-Iran peace agreement within the next 1 to 2 weeks that fully reopens the strait. That collapses Brent towards $70, restores 2 rate cut expectations for 2026, and could propel the S&P towards 7,400 as consumer and industrial spending pent up over 6 weeks of disruption gets unleashed.
Given that distribution of outcomes, how should investors be positioned?
Highest conviction, maintain exposure to semiconductors and AI infrastructure names. The Bernstein upgrades on advanced microdevices and Intel reflect structural server CPU demand that persists regardless of geopolitical outcomes. NVDA is up 8.13% on the 5-day, above both its 50-day and 200-day moving averages, and the quantum computing catalyst from its Ising model announcement is adding a new layer to the AI narrative. Secondary conviction, financial services, where breadth is the strongest in the market. The steepening yield curve and record trading revenues give you both a fundamental and technical tailwind, gradually increase over the next quarter. Tactical hedge, if the VIX pulls back toward 15 or 16 ahead of the ceasefire deadline, that's an attractive entry for put spreads on oil-sensitive consumer names, particularly cruise lines and airlines, as insurance against the risk case. Avoid list, consumer defensive looks like a trap, the worst near-lows reading of any sector, with margin pressure from input costs and no offsetting revenue acceleration. Also avoid unhedged fuel-intensive industrials and cruise operators until the Hormuz situation is resolved.
How does it all fit together?
When you step back, this is really about a market that has priced in the ending of a war that hasn't ended yet. Equities are at all-time highs because investors trust the taco playbook. As Moody's chief economist Mark Zandi put it, everyone thinks they know what the script is. Now they just need to follow the script. The oil market disagrees, with Brent one session away from triple digits. Bank earnings show the financial system is thriving in the volatility, even as Goldman's stumble reveals the cost of being on the wrong side of the rates repricing. Regional Fed data is flashing stagflationary signals, strong activity paired with surging input prices, while the labor market remains tight at 207,000 jobless claims. The consumer is caught in the middle, absorbing $4 gas and subscription price increases, while retail investors, according to J.P. Morgan flow data, are just now chasing the rally from the 10th percentile to the 55th percentile of participation. The alternative view is compelling and deserves respect. If the taco trade is right and a deal comes together, you have a market that just proved it can absorb the largest oil supply disruption in history, with an 8% drawdown and a full recovery in under 3 weeks. The AI boom remains a structural force that functions, as Zandi noted, independent of anything, including the war in Iran. In that world, 7,000 on the S&P is not a ceiling, it's a base.
Give us 3 takeaways to close.
First, the risk. April 21st is the single most important date on the calendar. If the U.S.-Iran ceasefire expires without extension, Brent above $100 could trigger a rerun of the March sell-off. Position sizing should reflect that binary event. Second, the market insight. Consumer defensive, with 14% of stocks near 52-week lows, is telling you that the oil shock is already doing real damage to margins in the part of the economy that's supposed to be safe. That's a leading indicator for broader earnings pressure if this drags on. Third, the positioning idea. Semiconductors are the highest conviction sector in the market. 6 of the top 10 gainers today were tech names. Advanced microdevices is at an all-time high, and the AI infrastructure build-out has its own demand cycle. Use any ceasefire-related volatility to add to that exposure.
Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.